It is Thirsty Thursday, 30 minutes until the start of trading. I'm losing my voice. I'm Matt Miller.
We'll take it from here. I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up, Netflix Upbeat forecast fails to win over investors, still questioning the broader impact of AI.
And another private credit warning. Marathon's Bruce Richards says software defaults could hit 15%, but sees no contagion risk.
Plus, a bidding war for Janus Henderson is underway. Victory Capital tops a takeover offer from Nelson Peltz's Trian. I feel fine, actually.
I know. It always happens. Your voice betrays you and makes you sound.
It's just the way I sound.
Okay, well, why don't you take a little bit of a vocal rest?
Yes.
Let me show the folks at home what Nvidia is doing, or at work. We are not even up 1% at the moment. We are only up, I don't know, less than 0.9%, even though it was a huge beat. More than 70% for the fourth quarter. First quarter outlook looks good, too. They boost their guidance for the year. But it just shows there's a lot of anxiety, a lot of conflict on both the impact of AI and just how things are priced right now.
Yeah, definitely one to watch, as it always is. Salesforce, on the other hand, down as its outlook failed to impress. Investors are concerned about the software giant's growth amid growing competition from artificial intelligence. You know the story has been riling the markets for weeks. Salesforce shares down 2.2% in the pre-market.
So let's get more on these stories. CEO Jensen Huang pushing back on concerns around growth sustainability.
I am confident in their cash flow growing. You need compute capacity. And that translates directly to growth, and that translates directly to revenues.
Let's bring in Bloomberg Tech co-host Ed Ludlow. Ed, again, the narrative is a really strong beat, but not enough to get shares higher than more than 1% this morning.
Yeah, it was a high bar from the buy side going into it as well, which is important to reflect. $78 billion plus or minus 2% does not include or reflect any contribution from data center revenues in China, despite the disclosure that they were granted limited licenses by the US government in the month of February to export H200s. And what Nvidia was saying is, we just don't know if the Chinese government will allow us to do that. The reason I bring that point up is that overhanging all of this is this longer-term projection of $500 billion of revenues just from Blackwell and Rubin systems over 5 fiscal quarters. And what Jensen Huang and indeed CFO Colette Kress outlined on the call was they are tracking ahead of that. And what they said previously at CES in January was that China may contribute to that. It's not in the near term. And so what they were trying to do is point to evidence that the broader AI ecosystem is very much alive and kicking because they're building on top of NVIDIA's compute. And you're right that the market wanted more.
Ed, what's the problem with Salesforce? I mean, I can't repeat enough how Workday's CEO said that OpenAI and Anthropic still use his software, and Salesforce is much bigger, much more integrated in companies. I mean, it must be much more difficult to live without. Why is their outlook disappointing?
So, the outlook, $46 billion, is basically completely in line with estimates. And what the story with Salesforce has been is organic growth versus inorganic growth. A lot of the growth that they are seeing, or even if it's perceived as muted, comes from their M&A activity in recent quarters and years. And so the question really is, when is all of this agentic in-house offering going to start paying off? And there was commentary around that they will indeed start to see more organic growth going forward in the era of agentic AI, which, Jensen Huang talked about as well. There was a pretty nice sweetener for shareholders with boosted buybacks. Not enough, clearly, with the stock down, but down 1.7%.
Hey, Ed, thank you very much for that. Ed Ludlow, and catch him at 11 a.m. on Bloomberg Tech, he will be speaking with the CEO of Snowflake. You can also catch Caroline Hyde on Bloomberg Tech, who's been tracking Paramount earnings. They topped estimates as it hopes to take over Warner Brothers Discovery, which also reported earnings. She joins us now. Caroline, I guess it's hard to interpret these earnings because everything could be different with these companies.
I think what was solid and what they're showing is that with integration of Paramount and Skydance, with the new asset that they now own by David Ellison, he is managing to do more with less in terms of profitability. They smashed expectations in terms of how much they're bringing in overall adjusted earnings. So that shows that even though revenue is on the downside, even though they're seeing all the myriad of issues that we continue to see, batter cable, whether we see the concerns about what people are doing, going in and watching movies, he's still able to steer a ship that even with revenue crimping a bit, we're able to eke out more with every single dollar spent. That's going to be important if they're thinking about whacking on another great big amount of assets. And it's important also when we get the numbers out of Warner Brothers, where we see revenue decline, where we see profits decline, but putting two things together for many will make sense. They have the scale, they won't have to fight each other out in terms of ads. In fact, maybe they can then score more ad revenue coming in for the cable business, which I might add for Paramount, cable's the only bit making any profit. But both are showing growth in terms of subscribers to the streaming. So maybe that will show some resilience. So this was really a way in which they could convince investors that this will be good if we merge these two for Paramount Skydance. And Warner Brothers Discovery is saying, look, we're just going to do our fiduciary duty and what is best for the shareholders in terms of the competing bids. Because Netflix, like, smashes them all in terms of revenue growth and earnings growth.
Actually, I hear often, and just yesterday, a CEO was telling me, for Paramount, Warner Brothers Discovery is a must-have. Like, they need this. And for Netflix, it's a nice-to-have. And clearly the shares in Netflix show that. Can they get this done?
Who, Paramount?
Paramount, yeah.
It's certainly the fact that they've reopened negotiations, the fact that they're only going to give the likes of Netflix 4 days to respond on the upped deal, the fact that overall they've convinced the board, even though it was so combative. Do you remember the state? We stooped so low in terms of the aggression that was being seen. The fact that David Ellison was claiming that Warner Brothers Discovery wasn't taking them seriously, that they were favouring Netflix from the offing. This has been a war of words. The fact that they've now been able to come back to the table, convince them with a $31 per share offer that maybe it's worth reconsidering, I think that shows just the real fierce commitment that David Ellison has.
By the way, do you and Ed hear that too on Bloomberg Tech, that Paramount, that this is make or break, that they have to get Warner Brothers Discovery?
I think that there's more onus and there's more fight coming from the Ellison clan, is what we're hearing time and time again. What's interesting on the flip side is, yes, look, we're about to have Laura Martin on the show. She has for years been saying consolidation is the only way forward in terms of media assets, because from Netflix's perspective, and what they want to convince everyone of, is that it's not just Netflix versus usual cable, usual subscribing networks and streaming. It's YouTube. It's the big tech, it's Amazon. These are the competitors of the future. You've got to have more cash on hand, and you've got to have an amazing array of content. That's what David Ellison needs right now.
Caroline, thank you so much for bringing us those earnings. Again, Caroline and Ed, catch them 11 a.m. on Bloomberg Tech. Another bidding war on our hands, apparently. Victory Capital offering to buy Janus Henderson for $57 a share, topping Trion's bid by 16%, who was in conjuncture with General Catalyst. Joining us now is Bloomberg Intelligence analyst Kevin Ryan in London. Kevin, this is a really fascinating saga because Victory had before tried to bid for Janus Henderson and before had a higher bid than what the current buyers are offering. So how will this one make a difference? Is $57 enough to wrestle Janus Henderson away?
I just don't know. And have they come too late? Because Janus Henderson seemed happy with Trion and General Catalyst. But what I can say is that the Trion bid is offering 1.5% of assets under management, and Victory are upping that to 1.8%, which I think is quite toppy historically. So 1.5, 1.6 times is the sort of average.
Janus Henderson and Trion, though, have historically worked closely together. I mean, that relationship must mean something.
Yeah, I guess it does. My sense is that if they go with Trion, there'll be another deal to put them together with another asset manager. Because I think what we're seeing here is that Janus Henderson has got just under $500 billion of assets under management. And in the game of running assets now, that's just not quite big enough. And it seems that the starting point is $1 trillion now, which is just extraordinary. But nonetheless, it seems to be the benchmark of being competitive in a market that is being brutal on margins.
Kevin, why is that? What has changed that makes this so necessary and that margins have gotten so compressed?
I think it's the rise and rise of trackers and ETFs.
But Kevin, isn't that an old story? I mean, we've had trackers and ETFs for a while now. Why is a consolidation just taking place?
Because I think certainly active managers like Janus Henderson have been reluctant to say, do you know what, the market's moved on. They don't want active management anymore. They don't want all these people sitting in fancy city offices. So it's taken this amount of time for the penny to drop. But top lines aren't growing. Your costs generally go up, even if you try and keep them flat, at around CPI 2-3%. So this has been relentless over the last decade. And as I say, I think the penny's just beginning to drop with managements, that they just need to be bigger.
Such an interesting saga to follow. Kevin, thank you so much. Kevin Ryan from Bloomberg Intelligence. Let's get a check on your future markets this morning. You are seeing very, very tepid moves. I mean, maybe not moves at all. And maybe that's because Nvidia isn't moving much. But we did end yesterday just 0.5% away from all-time highs. NASDAQ 100 futures slightly lower. Russell 2000 futures, those outperform up 0.2%. Some of the single stock movers, Matt.
Yeah, let's look at some of those stories. One of them near and dear to my heart. Stellantis swung to a loss in the second half of last year after scaling back its EV push. That cost the company nearly $30 billion in charges. Also, Hertz earnings per share missed estimates, but revenue slightly beat. Nonetheless, the stock being punished in the pre-market, down 4%.
And then there's Trade Desk. Their forecast was weaker than expected. It sees competitions in the ad space from giants like Amazon down nearly 14%. But coming up on the show, we're going to get to the big earnings reaction. It's Nvidia. Mizuho's Vijay Rakesh, who has an outperform rating on the stock, is going to be joining us next. This is Bloomberg Open Interest. Let's get to high interest, a look at what's making headlines around the world. The U.S. and Iran have started a third round of nuclear talks in Geneva today as President Trump's March deadline looms. Tehran says it's flexible, but defends its nuclear rights. Meanwhile, new satellite images show Iran preparing and hardening nuclear sites damaged last year, undercutting Trump's claim that the U.S. would easily win a conflict. Oil markets, those remain on edge. Cuba says that its Coast Guard killed 4 armed Cuban Americans after their Florida-registered boat allegedly opened fire while attempting to land. 6 others were detained. Havana claims that the group carried assault rifles and Molotov cocktails. The U.S. is investigating as tensions escalate under President Trump's crackdown on Cuba. Massachusetts Senator Elizabeth Warren is urging regulators to investigate Wall Street executives over their ties to Jeffrey Epstein. In a letter to the Fed, the OCC, and FDIC, she demands public probes and answers by March 12th. In her letter, Warren called out executive J.P. Morgan, Catherine Ruemmler at Goldman Sachs, and Jess Staley, the former CEO of Barclays. Elsewhere, Nvidia's upbeat forecast drawing a lukewarm reception from investors. CEO Jensen Huang pushed back on AI concerns. Let's bring in Mizuho Securities analyst Vijay Rakesh, who has an outperform rating on the stock. Vijay, a tepid response from the market. We're only up 0.5% this morning. What was your take on the earnings set?
Yeah, thanks, Dani. So I think Nvidia overall was a pretty solid, clean beat and guide. I think if you look at their data center revenues, it is accelerating from up 75% last quarter to up 85% in the next quarter, year on year. Networking had the strongest quarter in their history, up almost 260% year on year. So massive growth across verticals. If you look at 2026, data center revenues this year will be $340 billion. So you're seeing some massive numbers come through. So, and it's very tough not to own this. They're growing 70% this year, 30% plus next year. Those numbers will probably go up. And the stock is trading at 20 times forward. So it's very hard not to own this thing. And so we think this will continue to move higher.
But everyone does.
Catalysts ahead.
Go ahead. Everyone does own it. I mean, we're talking about a stock that's, 10% of the S&P, 8% of the S&P. And, we've been buying it for 3 years now. So maybe the marginal buyer just isn't there for these shares.
Yeah, I think, Matt, that's a good point. I think over the last 2 quarters, we think Nvidia is probably a little less owned. It is probably a little under-owned in the last 2 quarters, given how the stock has tracked. So I think there's an opportunity to now come back because all the metrics on the data center side, networking side seem to be accelerating. They talked about token generation. That seems to be starting to pick up as well. They talked about the cost per token going down 10x, meaning the cost of inferencing cost per token will be down to a 10th going out, and that will be key for all the hyperscalers to continue spending. So we have seen the stock trade sideways because of some of the hyperscaler capex concerns, but now as the costs start to come down, you're seeing more token generation, more agentic AI, software getting disrupted. You will start to see more money flowing back to these names. There is also significant catalysts ahead from GTC coming up. They're presenting at conferences. There's a huge Rubin launch in the back half of the year. So there's plenty of reasons to step back in.
Costs are coming down, but maybe the competitive dynamic is also changing within that because you have custom chips coming from the hyperscalers. You have emerging technologies and chip makers also trying to come into. Vijay, where does the state of competition stand for NVIDIA?
Absolutely. That's a great point. So I think we do see internally hyperscalers drive some ASIC platforms, custom ASIC platforms. But that's because they can control that ASIC platform internally. They can control the supply. They can control the cost there. But NVIDIA still leads the globe in training and inferencing. They are the golden standard. That's what the ASIC guys are chasing in terms of performance. But it's a very risky trend as well, right? Because NVIDIA on every year, they keep bringing inference costs down, training costs down. So the ASIC hyperscalers have to continuously be on their toes to evolve the ASIC roadmap as well, so that the gap between the GPU and the ASIC does not become too far wide. And so that's always a tricky proposition. But the reason you have these ASIC platforms coming on for the hyperscalers is because they want to control that roadmap. They want to have a lower cost option. But when you look at training inferencing, no alternative to NVIDIA in terms of where they are in the lead. So
I wonder, Rakesh, if they're constrained by capacity in terms of production, right? They can't sell as much as, we know they are, but maybe that's part of the problem, right? And also, what about competition? AMD seems to be making headway here. Is it a viable competitor, something that could worry shareholders?
Yeah, no, I think in terms of capacity, they have very good line of sight on their capacity. They have obviously a very strong partner with TSMC. And they are adding capacity in Taiwan, in the US, in Japan. So that continues to be, a nice tailwind for them. I think they have pretty good handle on that. In terms of AMD, it's a good competitor. But, I think as you look at 2026, AMD's data center revenues are somewhere in the 17, 18 billion-ish, 18 billion plus minus. If you look at NVIDIA's data center revenues this year, 340 billion. So that tells you the math of where these things are going. Plus also, as you look at some of the new RAMs from NVIDIA, the performance in terms of Blackwell being 50 times the prior platform, Rubin driving 10x lower inference costs, and CUDA, right? We cannot forget CUDA because that's a huge software stack that's been a massive moat for them. Continues to drive a big value proposition for NVIDIA. So,
Vijay, when are we going to get management assuming some China data center revenue in their outlook?
That's a great question. I think this 340 billion obviously does not include any China. And China, as Jensen has himself noted, is almost 50 billion a year in incremental data center revenues. So, and that's not even in the guide or at this point in the numbers. So I think we should start to see that pick up in the back half because if anything, China does need the performance and the training platforms from NVIDIA. So.
Vijay, great to get your take as usual. Really appreciate you joining us. Mizuho Securities Senior Analyst Vijay Rakesh on NVIDIA. Coming up in the next hour, we'll give you more on the big chip maker with shareholder Brooke May of Evans May Wealth. This is Bloomberg Open Interest.
check on your futures market, going a whole lot of nowhere. We are, though, within 0.5% away from an all-time high. Who knows if we're going to get there? So the S&P, again, at 69.64 for your futures session. NASDAQ slightly weaker. Russell 2000, that's doing pretty well, up 0.3%. So at least something is moving in this market. Some of the individual names are moving too. IonQ surging 15.5%, growing adoption for its quantum computing technology. And Celsius as well, Matt, having good
Yeah,
news.
IonQ, really a name that we know. Celsius,
well put, Matt.
Celsius, it is a $12 billion company. Celsius sales more than doubled from a year earlier following its acquisition of Alani Nu. So that's a big bump there, 16% for Celsius.
Have you ever had one before?
I have not. I had a bad Red Bull experience once in Vienna, and I never tried it again, but
I don't think I want to know what that is. That sounds crazy, but
Shonali Bassick used to drink Celsius by the case.
Yeah, well,
maybe she still does.
So I don't drink coffee, but sometimes if I'm really tired, I learned this from Anne Marie, is have a Celsius, and it is like rocket fuel. It's amazing.
That's why it exists.
Yes.
Memory chip stocks are getting a big boost after Nvidia's upbeat forecast. Except for Micron.
Yeah, it's
obviously.
kind of ironic that Nvidia has earnings. It barely moves, but it talks about how its gaming division is challenged because the cost of memory chip stocks, and SanDisk is the one that moves. That's the big beneficiary of Nvidia earnings.
Yeah. By the way, it's funny to hear gaming division because when I was a kid, that's what Nvidia did.
That's all they did.
You know?
Yeah.
It was all about video game graphics processing. We have less than 4 minutes until the opening bell. We're going to kick it off today with Ann Barry, so we're very excited about that. She joins us, I hope here on set. This is Bloomberg Open Interest. Moments away from the start of trading on this Thursday morning. This is Bloomberg Open Interest. I'm Matt Miller, and I feel fine. I just have lost my voice. We have S&P futures not doing very much right now, swinging back and forth between gains and losses, as Dani said, because Nvidia really isn't doing much after earnings yesterday. So those earnings not only failing to move Nvidia shares, but really the market. We expected a big beat to lift the market or a miss to drop it, and none of that's happening. Lumen ringing the opening bell on the New York Stock Exchange. We've interviewed the CEO before. They provide solutions and in essentially telecoms and data centers, and the shares are down 33% over the past 5 years, but they've been, on a bouncy path the last couple of years. Elemental Royal ringing the opening bell down at the NASDAQ.
Well, they're all in ties. I think that's
site.
the first time I've seen NASDAQ men all of them wearing ties.
I don't get the no tie thing.
But I think
really
it's like,
don't
I'm at the
understand
NASDAQ. We're like techie. We don't need ties. We're not as formal.
Right. I mean, Ed Ludlow sometimes tries that. Have you noticed?
He always tries that. I never see Ed Ludlow.
Does he
in a
never
tie.
wear a tie?
Yeah. Do we have him on again on the
that?
show? We need to do that.
I feel like it's part of the dress code for being a television anchor on Bloomberg.
He's an SF. He doesn't need a tie.
Okay.
Anyway, speaking of all things tech, Nvidia actually negative now. It's down 1%. What a ride for Nvidia. So first reports earnings, it was falling in the post-market trade. The pre-market trade, it goes up by 1%. Now it's down by 1.2. I'm sure this thing's going to be completely different by the time we close, but it had a huge beat in the last quarter. It boosted its guidance for the year, but it just shows how conflicted investors are and concerned they are, Matt, about AI and its impact on the world's most valuable company.
Yeah, I figured they wouldn't be worried about this part of AI. We all see the CapEx going to these chip makers, and this chip maker specifically is supply constrained. So it's interesting there. Salesforce is one I would understand, even if I don't think it's true that AI is going to eat CRM lunch. They failed to impress with their outlook, I guess. The shares were down in the pre-market. They're up in the cash trade. Investors worried about the growth because of that sales outlook, the competition from AI, if there is any. But I say, I've been saying the past couple of days, if these AI companies, Anthropic and OpenAI, are using Workday software, and I imagine they're probably using some CRM as well, I don't see why we think that a smaller company wouldn't have to.
But the problem is that they're using it for now, that they're so big and they're so sticky, but that doesn't always last, and maybe at some point in the future they won't have to use them. That's what we're pricing in, this really uncertain future.
Right, but I'm not sure it's 2 years, as Citrini put it. You know, if it's 10 years out, then I don't know why you would sell the shares now, but.
I mean, we're just pricing in mass uncertainty.
Let's ask someone who does.
Correct.
Threadneedle Ventures founder Ann Berry here with us on set. And what's your take on the Citrini research piece, on this sort of dark sci-fi idea that AI is going to replace like most white-collar workers and software like Salesforce or SAP?
So I read it, and they're sort of saying out loud what a lot of people have been fearing and thinking, right? So when you crystallize that, it becomes a moment. So I read it, and I'm getting increasing anxiety about the idea that software, or rather sort of AI, could end up replacing a lot of white-collar work. And here's why I say that. I have now spent an inordinate amount of my own free time, weekends, before and after work, using Claude, for example. And I'm just wowed by how much it can do. And I'm certainly not going to be the most sophisticated user of it. And there are a couple of things I see there. I'm now making recommendations in board meetings that, frankly, we replace certain functions or certain subsets of functions with more aggressively training our workforce on how to use these models and how to use these add-ons. And then the other thing, too, just to the conversation you were just having, you see the ability to plug in Claude to Salesforce or to PowerPoint, for example. This reminds me a little bit of when Google used to place ads on Yahoo, right? Everyone is getting exposure to something like Claude's Anthropic now, or something like ChatGPT. At what point is all the data getting sucked out to the likes of Anthropic, and then they suddenly have the ability to replace the software that they're partnering with?
Right. What if the software isn't replaced, but it becomes the plumbing, that they still need that data? Surely in that case, it's pretty bad for these companies too, because where do margins go?
Right.
If you're all of a sudden just plumbing and no one
Absolutely.
cares about your name, they just want you for the data and the customers maybe you already had, that also seems like a reason to sell some of these companies.
Yeah, absolutely. And here's another example. If I were to go, this is going to be an unpopular thing to say out loud, but I'm going to say it. If I were to go and hire a consultant right now, one of the big brand names, an Accenture, whoever it may be, you bet I'd be saying, why is your pricing X? Why has it not come down versus the last time you pitched me 18 months ago, when I know that your cost of executing against this, given the AI tools you're using, is almost certainly going to be lower.
Can I just ask, with consultants and with CEOs, I know you talk to so many industry leaders, is there even anyone that they can turn to that can tell them what to do with their business? I mean, all of this, I know AI in some form has been around, but it feels like all of this is happening so rapidly. If you're a CEO and you're like, I have no idea what to do, is there even the knowledge out there, the talent out there to help guide companies through a period that basically no one knows what's going to happen?
So the person I had a version of this conversation with is one of my old business school professors, Kareem Lakhani, and he's leading the AI effort at Harvard Business School. And what he said, and again, he sees more leaders coming through asking exactly that question, asking for his counsel. And he says the following: you need to get your hands dirty. You've got to go use the tools yourself. If you're going to have any conception of what they are capable of, any intuition for it to make the judgment, so even if a consultant does turn up and give you a recommendation, you can't make a judgment or a decision on what to do with it unless you yourself have exposed your own time and energy into getting into the details of this. So I think there might be people with ideas, but decision makers can only make decisions by having exposure.
All right, so yesterday we were talking with Catherine Borrell-May from Goldman Sachs, and she was saying that she likes companies that are AI-proof, like we used to talk about companies that are recession-proof, so hardware, industrials, and that sort of thing. What do you like out there? What makes you less afraid to buy?
Well, I like those companies. I wouldn't even call them AI-proof. I would call them AI-enhanceable.
Okay.
And I'll give you one example of that. I love industrials too. I run an industrials company. I'm trying to think about the thesis I've invested behind, and I've come and discussed with you over time. And one of them is industrial distribution. What an industry that is ripe for taking AI and improving SKU selection, portfolio management, demand planning, route optimization. And then I say, look, healthcare is not going away, and in fact, demand for it's going up. So Henry Schein's one example. It's not talked about very often. It's not a sexy business, but it's $10 billion of market cap.
Healthcare?
Healthcare distribution, products going out to dental offices, veterinary clinics, doctors' offices. It's not going anywhere. Distributes 33 countries, 140,000 plus deliveries a day. It's a massive business. Can you imagine if they can get its grip on AI, to your question, Dani, get the right guidance, get the right systems in there. And this thing's trading at just north of 11 times EBITDA, which in this market's pretty attractive.
I'd also be super interested to hear your thesis behind Clear, because I know that's a company you like too.
Yes, I do like it. I added that in the fall. And here's why. It's, again, this idea of take a thesis and try and find other ways to play it. I've been long experiential, travel, concerts for a long time, and all those assets have run up, Live Nation, TKO. So I said, okay, what's the adjacency? And I looked at Clear. I'm a user of the product myself. And I think it's one of the few brands at the moment that people actually trust with their biometric data. I think there's a lot of fear around it. And people are saying, we're actually okay with Clear using it when we go and try and clear security at the airport. And what I like is they're now expanding. They announced a partnership with Mount Sinai.
I hope so.
You hope they're expanding.
I've actually used them at Mount Sinai.
You have? Okay,
yes.
Talk about that. What did you do?
That was great.
Yeah.
When you say it, I think about the airport experience.
Yes.
And my wife doesn't have Clear, and I do.
Right.
So she'll go TSA pre-check, and I'll go
with
Clear.
her?
No, because we want to see who can get there quicker.
Okay.
You know, and I lose a lot.
Okay.
And also, it's like only available at Detroit and LaGuardia.
Not everywhere yet.
Yeah,
it's not everywhere. But at Mount Sinai you went. I guess you checked in for your doctor's appointment. And the idea is with medical records, it's a nightmare to try and get hold of your medical records. You still have to go get it on CDs. This is a way that a biometric access point can expedite access to it. And that's what Clear's moving into. So I added it. They've overshot, I think, a little bit yesterday. They're up sort of nearly 40%.
Producer Will Shaker says Yankee Stadium also.
Yes, that's right.
Yeah.
That's right. Venues.
I want to ask about cybersecurity and quantum. We were talking about IonQ earlier, but I know that you like this sector as well. What's your pick?
I think that Palo Alto Networks is on the money when it comes to looking at quantum. I think the baby's being thrown out with the bathwater. We've seen this sell-off because of software. And I would say cybersecurity, the demand for it's going to go up, not down. And I think Palo Alto Networks is getting punished right now because it's going through an integration lift, bought CyberArk, big deal, 2 other integrations on the cusp at the same time. But I think they'll get through it. And I think they'll come out stronger the other.
You've liked this company, by the way, since I started interviewing you like 3 years ago. And it's had a great 5-year run. I always default to 5-year, up 145%. But it's had a tough, let's say, 3 months, right? Or 2 months.
Yes.
You can see here, over a year, it's down 22%.
I like the entry point. I do. I think it's getting software punishment, and it's not a software business like the others. It's not a Salesforce. This isn't one that I think is going to be displaced by some of the LLMs.
So one of the babies thrown out with the bathwater. And so wonderful to have you on. Always a treat. That's Threadneedle Ventures founder Ann Berry. About 10 minutes into your trading day, let's get a check on your equity market this morning. If Nvidia isn't playing ball, neither will the overall index. We're down by 0.1%. Just looking at some of the leaders, a lot of financial names are doing very well today. Not any clear catalyst for that, or if there is, please write me and I'm being silly and missing it. Because look, you can see in the top gainers in terms of points added to the S&P, JP Morgan's on there, Berkshire Hathaway, Bank of America, Goldman Sachs, Amex is having a good day too. But again, it's Nvidia, that's the problem. It is dragging the S&P 500 down 12 points, nearly 13 points this morning. And keep in mind, the index is down just about as much. So if you were to somehow wipe Nvidia out of the index, the S&P would probably be higher this morning. A lot of the other big cap tech not doing well too. So when you look at the sectors, that's what you're going to see. Financials at the top, up 1.3%. Infotech, the worst sector, because of Nvidia, down 0.6%. So Matt, today is a good example of what happens when you have a very highly concentrated index. One, I guess, disappointing earnings can drag down the whole entire thing.
Yeah, also a turnaround from the futures, from the pre-market trade, right?
Yeah.
Nvidia was up 1% and change when I came in right before the show started, and now it's up 2.5%. Now it's down 2.5%. So really going to drag the index. Coming up, stocks stalling with that as Wall Street questions the sustainability of the AI trade, or at least as Wall Street takes profits for now. This is Bloomberg Open Interest.
A check on your equity market, and it's Nvidia that's causing the downturn. NASDAQ down 0.5%. S&P, that's down about 0.25%, while the Russell 2000, that's hanging on, up 0.2%. A turnaround from the future session for both the main index and for Nvidia. Let's get you some of the top calls, the analyst action that we're watching this morning. First up, TD Cowen raises NASDAQ to a buy after its investor day, citing stronger confidence in its platform. The firm says NASDAQ is a key beneficiary of AI and calls its valuation, quote, attractive. Next up, Truist Securities, that is upgrading U.S. Bancorp to buy, saying profits from lending will pick up this year. The firm's also confident on margins, expects credit card growth to boost earnings, shares up 2.8%. And finally, Nvidia posting a beat and raising its outlook. It's not enough, apparently. JP Morgan, though, calling it the biggest beat and raise the chip industry has ever seen. Truist says the company has significantly growth and stock upside potential. The market doesn't see it that way, I guess. Shares up 3.33%, Matt, or right. Down 3.33%.
Well, or they're taking profits, right? Because everyone already owns this stock. We've been talking about this morning. If you don't own Nvidia, then you're not really a diversified investor, right?
Yeah, very true.
Let's bring in an expert. Bloomberg Intelligence global head of technology research is here with us at the desk, Mandeep Singh. Mandeep, first of all, what did you think of the earnings? Just give us your take on the release.
I mean, stunning, really. That's the best way to frame it, because you don't see, companies of this size, one have, growth of over 70%, and then really keep beating their quarters the way Nvidia is doing it. So with that being said, the part that was interesting is they said 50% of their revenue, data center revenue, comes from hyperscalers. The other 50% is now enterprises, neoclouds, and sovereigns. And if they are guiding for 77% growth and they feel that part is going to accelerate, to me, that is music, because so far the risk to NVIDIA's story was hyperscaler CapEx. If it starts to decelerate, that's going to have a big impact on NVIDIA. Well, if their customer base is more fragmented and enterprises, neoclouds, sovereigns are buying, that's all inferencing revenue. And to me, that is more durable in terms of sustaining the high growth rates that everyone expects of NVIDIA.
Can you find any sore spots in the earnings that would explain a negative reaction? Or is this just something completely different and not based on fundamentals, what we're seeing this morning?
Yeah, I think right now it feels like more of, the SaaS complex really impacting NVIDIA, because at the end of the day, if SaaS companies are getting hurt, there's no way that people will spend more in terms of their IT budgets on NVIDIA, because NVIDIA is a chip maker. You have to translate that to software usage. Yes, we are seeing that in OpenAI and Anthropic's growth rates, but all of these software companies right now are bleeding. I mean, they're more in the value side and they always used to trade, as growth companies. So from that perspective, there is a disconnect right now that you see in the market in terms of where SaaS companies are trading and how fast NVIDIA is growing. But at some point, you want to see, a company like Salesforce starts to see top-line acceleration. Same thing for other software companies that should benefit from AI in theory, but right now it's not reflecting in their top-line results.
What about competition? I mean, a few years ago, we would say all these other chip makers are like a decade away from NVIDIA's capabilities. Now AMD seems to be getting some big contracts, at least, right? We were talking with Samba Nova. I know they're tiny, but super smart CEO, really fascinating company, a product that, at least as far as I can understand it, is really efficient. Are there cracks now in NVIDIA's dominance?
Actually, yesterday's print shows that competitors are way behind, because if they're growing networking revenue, at 350%, that's huge. So NVIDIA is now, the co-design that they're doing with their chips, networking, and other gear is what's really driving the total cost of ownership. And because power is the real constraint, everyone still wants NVIDIA systems, not just the chips. And that's the big differentiator between NVIDIA and AMD. Only Google TPU comes close, but right now, I would say NVIDIA, Google TPUs, and everyone else. And even AMD had to, do that deal with Meta, which really wasn't very attractive for them in terms of giving away stock warrants. So from that perspective, they have a clear lead, and that's not changing anytime soon.
It's just a mind-boggling thing of hearing you talk about just how strong they are, and then looking at that screen and seeing shares down 3%.
But they're up 1,400% over the last 5 years. So they're down 3% today.
Yeah, but it used to be Nvidia would get a huge reaction to the upside because earnings were so strong, and there was a really strong set of earnings.
Just to me, it's so fascinating that we're all worried about AI eating software's lunch, but no one has talked about AI eating chip designers' lunch. Like, why doesn't Claude design a chip that's better than Nvidia's?
Well, I think there's so many use cases, and that's what Jensen highlighted. Claude Code, that is the use case around agentic AI that's taken off. But that's new. It's not really replacing existing software, what they're doing with Claude Code and Codex. And that's where you have to really hope that there are new use cases, productivity use cases that create these new markets that everyone feels excited about. I mean, really, the coding agent use case has taken off, and that's what Jensen called out as the real driver of inferencing use for their chips.
Mandeep, thank you so much for joining us this morning. Off the back of those Nvidia earnings, Bloomberg Intelligence Global Head of Tech Research, and maybe the smartest man on this planet, Mandeep Singh, coming up.
And a great tennis player.
I would love to play you, Mandeep, one of these days. Coming up, Stellantis shares make a U-turn as the automaker CEO strikes an upbeat tone on the U.S. We're going to have that story coming up next. Stay with us on Open Interest.
The CEO of Stellantis, Antonio Filosa, says he expects returns in North America to improve, boosting the car maker's share price. Joining us now is Bloomberg's Gabby Coppola, who covers Stellantis for us out of Detroit. And I sure hope that their sales in America improve, because they've had a real problem with the crown jewel of, American brands, Jeep, as well as Dodge. Chrysler doesn't even make cars anymore. What are they going to do?
Yes, Matt, that's right. I think they are leaning hard on North America and getting their new products out the door. They have a new Jeep Cherokee hybrid. Remember, this is a product that had been dropped from the lineup for a couple years, and it's finally, they ramped up production in December, and it's supposed to hit dealerships in March. But the big thing Filosa talked about was the Hemi engine, the Hemi V8, baby. I mean, they are just undoing a lot of product made CEO. They're bringing back, combustion muscle cars after, just a few years ago saying these are the last combustion muscle cars we're ever going to make. Now they're making them again. So there's just so much work to be done in sort of just fixing the product lineup, and they are getting that out now. But it's not just having the right product. It's also they have really tough quality issues. That was part of why you saw they, had like a huge write-down, the biggest of all of the D3 write-down, which they released earlier this month. And yes, a lot of that was charges for EVs that didn't sell, but a lot of it also was quality and warranty issues and things like that. So they've got a lot of operational problems on top of trying to get the right product out the door.
I mean, maybe they watch this show. I've been saying, axing the Hemi was the biggest mistake they could possibly have made. I say it so much that they couldn't not have heard me. And
I think they agree with you. And that's why they're talking about they're bringing back more variations of the product. They're just leaning hard on all of the, core product because President Trump rolled back the CAFE regulations. That is liberating Detroit, as we've written about.
I like the 345. I own the 392. They need to bring back the 426. Hopefully Antonio Filosa comes on this show with us. Gabby, thank you so much. Gabby Coppola there in Detroit. Listen to my podcast, Hot Pursuit. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger with a market that's falling alongside Nvidia.
Coming up, Nvidia's upbeat forecast fails to win over investors, still questioning the I guess they're questioning the broader impact of it. They can't really be questioning the broader impact.
No, they got to be
of
questioning
AI.
like the valuation or something like that.
Yeah.
Here's another warning for the market. Marathon's Bruce Richards says that software defaults could hit 15%, but he sees no contagion risk.
He was the first person I heard warn about software years ago. Plus, a bidding war for apparently Janus Henderson is pronounced Janus Henderson. I can't believe that, but there's a bidding war underway. Victory Capital tops a takeover offer from Nelson Peltz's Trian.
We are learning so much today. We begin with Nvidia's lukewarm reaction. Mizuho senior analyst Vijay Rakesh remains bullish on the stock.
They are the golden standard. That's what the ASIC guys are chasing in terms of performance. But it's a very risky trend as well, right? Because Nvidia on every year, they keep bringing inference costs down, training costs down. So the ASIC hyperscalers have to continuously be on their toes to evolve the ASIC roadmap as well, so that the gap between the GPU and the ASIC does not become too far wide. And so that's always a tricky proposition. But the reason you have these ASIC platforms coming on for the hyperscalers is because they want to control that roadmap.
Joining us now is Brooke May, Evans May Wealth Managing Partner. She is a shareholder in Nvidia. And Brooke, I was talking with Dani about this earlier. Like, everybody is a shareholder in Nvidia, right? If you own this market, you own Nvidia. It's a big piece of the S&P, a bigger piece of the NASDAQ. What's going on here with the shares? Why are they selling off after what our own tech analyst, Mandeep Singh, was a stunning earnings report?
Good morning, Matt. Agreed. I thought the earnings report was outstanding. So this muted reaction really is just a reflection of the fact that the earnings were priced to perfection. Not only did they beat on revenue, they also beat on earnings. And earnings growth was up 82% year over year. Revenue growth was up 73% over year. And they're doing it with 75% profit margins. As we know, though, right now, this is an environment that's really focused on guidance. And they guided well. They're going to maintain those 75% profit margins and grow revenue from $68 billion to $78 billion. That's the kind of company I want to own. So really right now, it's just a matter of the fact that they were priced to perfection.
So when you see a decline like this of nearing 4% this morning, Brooke, is it time to back up the truck?
It's our largest holding in our growth strategy. We own about 11 to 12% in our growth program. And we're going to keep that allocation. Near term, we might see some volatility as there's concern around CapEx or with AI spending. However, they're expected to grow earnings about 40% a year over the next 3 years. And if it's trading at about 40 times forward earnings, that 1-to-1 ratio is very attractive. So we're not concerned at all about the valuation, and it's not a stock that we want to pare back.
But this, Brooke, this is exactly my point. Like, you and many other investors already have the truck full of Nvidia. When you hit a speed bump, some's going to fall out. So, who's the marginal buyer?
I think that, you've missed the boat if you haven't owned Nvidia. But, they're going to continue to grow their earnings. And so there will be demand there. But you're right. It is a major holding in almost all growth strategies.
It does seem to be weird, Brooke, because on one side we're saying, is this thing too highly valued? Is there a bubble in the price? And then on the other side, we're saying, Nvidia and all of its AI infrastructure world is so amazing and so incredible that it's going to completely disrupt software. So if you believe in the future and the promise of AI, do you at the same time logically in your head need to also think, I can't really own a lot of these software names then too?
Software is a concern. The big software players, though, aren't going to go out of business. We're just in a recalibration. They're going to figure out how to partner with AI to continue to evolve. But that recalibration is going to take a minute. So I don't think that this is an entry point for software, and I do think there are going to be struggles. However, those companies will reinvent themselves, continue to innovate, and they're not going to go out of business. There is concern, though, around AI CapEx spending, and I think it's overblown. If these models continue to evolve, companies are going to continue to buy. In fact, Nvidia is expecting sales to grow with Alphabet 100% over this next year, Meta up 75%, and Amazon up 50%. So there's demand out there, and they've got partnerships with just about every big tech company. So we think that there's going to continue to be demand for AI chips, especially NVIDIA chips.
What else do you like, Brooke, or what else do you have in your growth portfolio that isn't an AI company?
Mm-hmm. We own energy stocks. We also own industrials. So, we really have a diversified growth strategy. We feel like it's not a great time to try to overweight or underweight certain sectors. But what's really exciting is the breadth of this market. We've seen Mag 7 earnings dominate the S&P 500. In fact, if you look back to 2023, 3/4 of the earnings in the S&P 500 came from the Mag 7. This year, we think only about 50% of the earnings on the S&P are going to come from the Mag 7. So clearly, there's greater participation. Other asset classes have come to the party. In fact, 60% of stocks in the S&P 500 have beaten the benchmark. And if you look at the top 25 performers year to date, not one is a Mag 7 company. And as we know, international and small cap have been out of favor. Right now, they're hot. International is up 10% year to date. Small cap is up 7% year to date. And if you don't own gold in the portfolio, you've missed out. So, we're back to traditional diversification and those investors being rewarded.
Even so, though, Brooke, if you don't count Nvidia and yesterday's earnings, companies in the S&P grew earnings by 13% in the fourth quarter. That's almost 6 percentage points better than expected. Yet, in that period of time, the S&P fell 1.7%. The data, if you take it from JP Morgan to Walmart, that's tied for the worst performance during an earnings season in the past 10 quarters. Why aren't earnings being better reflected in this index right now?
It's a product of the performance last year. Last year, the second half of the year, earnings expectations weren't robust, but they were decent. Quarter after quarter, we were expecting 7-8% earnings growth, and it was coming in double digits. And the market performed last year. We had stellar performance. So this year's returns, or this year's earnings growth, was already priced in. We think, though, the S&P could grow earnings at 14 to 15% this year, but it's going to take looking out to 2027 before we really see a meaningful move up in the market.
Are you hedged at all, Brooke? I mean, I know that this market's been kind of flat for a few months now, but what do you buy for a hedge? Gold obviously has gone absolutely bonkers, and Bitcoin has dropped. The VIX is at 20, I think, but it doesn't look like a lot of people are buying volatility.
We aren't hedging the portfolio. We're just participating with broad diversification. So I guess if the risk is in the S&P 500, adding that small cap, adding that international, adding gold to the portfolio allows us to participate in other areas if U.S. large cap is going to be somewhat muted.
Brooke, thank you so much for joining us this morning. That's Evans May Wealth Managing Partner, Brooke May. And let's get a quick check on your markets over just about 40 minutes into your trading day. Again, it's a negative market because Nvidia is down, and those losses are gaining steam. Nvidia nearing a 4% drop. S&P down 0.4%. NASDAQ leads that drop too, down 0.8%. Bonds acting as some sort of ballast in your portfolio. Yields lower by 3 basis points. It's also why small caps are outperforming. And there you go, Nvidia down 3.4%, Matt.
Coming up, Blackstone's AI bets are powering a 20% gain for wealthy investors. We'll talk to Vijay Patel, who leads that fund next. This is Bloomberg Open Interest. Let's get to high interest now. Look at what's making headlines around the world. McKinsey is moving up recruiting for its 2027 summer interns to this spring, pressuring rivals like Bain to follow. The move escalates the battle with investment banks for top students. Career advisors warn the earlier timeline could sideline late starters and heighten stress in an already tight job market. Sweetgreen's big bet on healthy fries has backfired. Workers warned that so-called ripple fries were too labor-intensive, but management pushed ahead with the nationwide launch anyway. The air-fried chip required constant baking to stay crisp, The flop caps a brutal year for Sweetgreen as the salad chain lost nearly 80% of its market value, with analysts saying the brand needs execution, not reinvention. And a publicly traded private credit fund managed by Blackstone has started marketing bonds that will be due in 2029. This comes right after it said one of its big loans to the software company Medallia has lost more value. The news adds to growing worries about risky loans in the private credit industry. Dani?
Let's talk about a very different Blackstone story. Maybe some concerns still swirling around private credit. But for private equity, Blackstone is riding the AI wave, and wealthy investors are cashing in. Its private equity fund for individuals just posted a 20% net gain, fueled by bold bets on SpaceX, OpenAI, and Anthropic, with nearly 30% of the returns tied directly to AI. Let's bring in Vijay Patel, CEO of Blackstone's private equity fund, BXPE. Thank you so much for joining us this morning.
Thank you guys for having me.
And I got to say, the fund is a really interesting one, because on one hand, you have like these high flyers, OpenAI, SpaceX, and then like subs with Jersey Mike's. How do you think about the actual composition of this thing and what's in it?
Well, when we built our perpetual strategy, what we really wanted to do was mirror the way Blackstone built its private equity platform, right? And so if you look at our private equity platform, yes, we're probably most known for our large, mature buyouts, Jersey Mike's, Medline, Copeland, these big, important companies that serve an important part of the economy. But the platform is actually a lot broader than that, right? So we invest in buyouts, we have opportunistic investing, we have life sciences, we have secondaries, we have growth. And the reason we built our platform that way was to be able to allow us to deploy capital across different strategies, depending on where we're seeing the most attractive relative value across the market. And our thought was to have a perpetual strategy that could manage and benefit from that level of diversity.
You're not majority shareholders in these AI companies or the rocket, ship maker, but you're not just any investor. You're Blackstone. So I was looking at your portfolio and wondering, are there any synergies here? Like Copeland, don't they do HVAC compressors?
Yeah, of course.
Could they be used in SpaceX rockets or, in data centers? And do you get astronauts to eat Jersey Mike's? Like, I know Danny DeVito hangs out at your office all the time. So are there any synergies that you can arrange as a shareholder?
Look, I think one of the things that we've done quite well across our portfolio is find ways for our portfolio companies to be able to work together. And one of the places you see that actually quite acutely is actually across the AI value chain. Like if you look at the data centers footprint that we have as a firm, and then you look at the number of the service opportunities and derivative plays that we've done around data centers, those businesses can actually benefit quite well. And when you look at like an OpenAI, an Anthropic, or a SpaceX, one of the benefits that we've had as an institution is really looking at our portfolio companies and understanding where they're going. So we have 270 portfolio companies. We're talking to our CTOs. We're talking to those engineering teams to figure out what they want to go build on. And one of the things that we were hearing quite strongly was this interest in building on top of the Anthropic platform. That's what gave us so much conviction in terms of making an investment into the company.
So will you talk to an Anthropic and OpenAI and then think, maybe we shouldn't do any more software deals? How are you thinking about that? What's your exposure in the portfolio?
So when you look across the portfolio more broadly at Blackstone, we're a very balanced investor. We haven't kind of overinvested in any one sector. We've tried to keep our exposure limited across the board. And so when you think about software and what's happening in the market today, I think we have taken an approach of really trying to focus on mission-critical software companies, ones that have very high friction cost in terms of removing workflows, and frankly, focusing on companies that have high renewal rates, important companies to their customers, proprietary data. When we focus on software companies that look like that, what we tend to find is that they're actually performing quite well, right? We're actually seeing good growth, we're seeing earnings going up, we're seeing margins going up. And so we think that portion of the software economy is actually going to handle pretty well relative to the AI pressure that's coming, and importantly, actually be able to enable their workflows to do better.
Did you have a take on the Citrini research piece? I mean, we talking about friction, talking about software, right? But it was also, there was much more than that. White-collar job losses, destroying the consumer-led economy. What did you think?
Well, it's interesting. I think when you look at the Citrini report, I think the first thing to look at is that first line. What they did was a scenario, not a prediction, right? What they were really looking at was in a world where this happens, what would this look like? I think it's less about what exactly is the world going to be. And I think, there is certainly the risk of disruption across the investing landscape from AI. We've seen that over the past few weeks across software, financial services, insurance brokerage. Right? You've seen that work its way through. I think our approach has been to go look for portions of the economy that we think are going to be better insulated. So we do have a significant number of investments in the physical economy. You mentioned Jersey Mike's as being one of them, but there's a number of investments that we have that we think are going to be well insulated from that risk. But that's also where the OpenAI and the Anthropics come from. Right?
What's your take on the circular nature of investments around OpenAI? We used to have this confusing graphic that we'd show about the 20 companies that are invested in OpenAI, in which OpenAI is invested in, at Nvidia, et cetera. I mean, it seems to be there's a lot of hot takes around these companies.
Well, what I would tell you is what you can't really refute is the underlying demand signals that we're seeing in the underlying companies. So the demand for the product continues to be very, very strong. The demand for the underlying infrastructure to enable these products continues to be very strong. And so we're big believers that this AI investment boom is going to continue, and that is going to fuel a very large AI productivity boom down the road. So we're not seeing signals of that demand side slowing down, and we're continuing to invest behind it.
So there seems to be these two mass hysterias happening in parallel that sometimes overlap a little bit. One, it's like, is AI going to eat the world and everything looks different? And the other one is this fear about private credit. And I know you're an equity guy, but you did used to wear a credit hat. A lot of it is revolving around retail funds, around funds of the wealthy, like the one that you run. How do you think about the liquidity profile of the fund and whether it matches a more retail-oriented investor?
Yeah. So I think you have to go back as to why investors are interested in the asset class to begin with, right? So if you actually look at capital formation across the alternative space over the last 30 years, it's been a tremendous amount of growth, right? And if you look at our capital base, our pension plans will be 20-30% into alts. If you look at families and endowments, they could be 50-60%, but private investors, individual investors, still 1% penetrated, so there's a lot of room to go. And the reason you've seen that growth is when you look at private equity in particular, it provides two real benefits to investor portfolios. The first is it's complementary and diversifying risk into a book, and then two, at least historically, it's provided enhanced returns. And to get that diversity benefit, to get those enhanced returns, has come at the expense of some liquidity, right? That's been the trade-off that investors have made for a long time.
But does everyone expect that that's the case? I mean, is there enough education out there to tell people that these aren't exactly as liquid as other types of funds might be?
So you're actually hitting on, I think, the exact right point, right? We are in the early stages of a big secular shift of private wealth capital coming into the alternative space. And we do believe that it is very important for managers to spend time educating the market on how these products work and what the risks are. And so we run these events called Blackstone University. We have them at Blackstone in New York. We actually run them regionally, where we invite financial advisors and members of the wealth management community to actually understand the products at a deeper level and make sure that they are able to articulate the risks to their clients so that it's suitable for them.
Hey, Vera, we're going to have to end it there. Thank you so much for joining us this morning.
Thank you.
We really appreciate your time. That is, of course, the CEO of BXPE. Coming up, a hostile takeover underway for Janus Henderson. We're going to have the details next. You are watching Bloomberg Open Interest. Victory Capital has offered to buy Janus Henderson for $57 per share, topping Trion's bid by 16%. Let's discuss with Bloomberg finance reporter Catherine Doherty. Catherine, it's been a battle before because Victory comes in and says, we tried to make a bid and they ignored us. But this one is topping the Trion bid by quite a lot. Is it too late for them, though?
So what's significant about this bidding war is they're coming forth and they're not just saying, hey, this is on a percentage basis much higher than your previous offer, but they're saying we have the capital, we have the banks lined up to both in cash and in debt come forth with this new offer, and they're basically saying that they can stand it up. And this is also reflective of just the broader consolidation of the asset management industry. So it's really speaking to what we might see going forward. I think that this deal and the bidding war again that it's representing, we could see further M&A and offers going forward, not just with this one, but with other asset managers across the globe.
That's exactly what I was going to ask. Like, how much is this going to pick up? How focused are you on M&A with asset managers this year, as opposed to, 24, 23?
I do think, if stepping back even broader than that, it's reflective of just the M&A environment picking up. But asset management has been a hot area because they've been under pressure. They've seen some outpouring of their funds. People are moving into cheaper, passive alternatives. So this is really reflective of something that the industry is grappling with and trying to become stronger. That sometimes translates into more M&A activity.
So could Janus Henderson not really exist on its own? Like, is this, they had to do a deal with someone?
Well, they've already in the past done deals where they've combined and they've added the Henderson part years ago. So I do think that this is both strategic partnerships, and again, it's really for this deal specifically, with Victory coming in, they are the ones that would be benefiting from just adding so much more assets under management than what they currently are managing. Right. So for them, it's really putting them on a stronger foot.
All right, Cato, thanks so much for joining us. Catherine Doherty there from the BN side. Coming up, we speak to the CEO of one of the largest auto parts suppliers, Magna. This is Bloomberg. Auto parts supplier and elite automaker Magna International posts strong fourth quarter results and boosted its sales forecast for 2026. One analyst called it a monster Q4. The shares are up 20% just this year. We're only in the second month. This comes despite a broader slowdown in the auto industry. We have, fortunately, the CEO of Magna International, Swamy Kotagiri, joining us now via satellite. Swamy, great to have you on the program. Personally, I have been a fan of your company for many, many years, just because you make the G-Class in Graz, one of my all-time favorite vehicles. But you do so much more. I think you have like 80 production facilities in 30 different countries. What's driving this growth?
Hi, Matt. Thanks for having me, and I appreciate you talking about the G-Wagon, and we are thankful to our customer, Mercedes, in this case. Yes, we are actually in 27 different countries, and we have over 350 divisions across doing various systems and components for all global OEMs across the world. And on top of it, the one differentiator is we also assemble cars for some of the OEMs.
At the same time, though, global vehicle production is basically flat. So how are you pulling off that feat?
Yeah, this really is the proof point of our resilience in execution. We have had 3 years running of margin expansion, which is really goes to about all the initiatives we have in our operational excellence, a model that is just not dependent on the volume uptick. There is a lot of discipline in how we allocate capital. We're really focused on looking at product portfolio so it is aligned with the market share, what is relevant going forward, and so on. That's really the key variables that have helped us hit the year 2025 finish really strong, and we are really set up for 2026 in the same fashion.
I was looking through all the different parts that you make, and am curious, other competitors like Bosch, everybody knows their ABS and their IMUs, or Borg Warner, everybody knows their turbos or their Haldex. ZF, everybody knows about their HP transmissions. How come you don't have branded components? Because you make famously capable and successful all-wheel drive components, for example, and other stuff like seats and doors. And, the OEMs then take them and name them what they like, intelligent AWD. Why don't you brand some of your successful products to make a bigger name for yourself?
Yeah. I think we are a B2B business, Matt, as you know, and it's all about collaborating with the OEMs. Like, even if you have not branded, you know about the G-Wagon, who makes it, you know about our all-wheel drive, four-wheel drive, you know about our seats. At the end of the day, that's really the important part of it. Like you said, we have the largest share in all-wheel drive, four-wheel drive systems. Now we are working through the transition for hybrids and electric drive systems, and within the next 2-3 years, we'll be the largest supplier outside the OEMs making those systems. In most of the product lines that we have, whether it is our structural systems, we call it the Cosma, we have exteriors in plastics and composites, we have seats, we have mirrors, we have inside mirrors, we have electronics. And most of these product lines, we are in, top 1, 2, or 3 positions. And at the end of the day, if you're able to continue to execute this, gain market share, and provide the value to the shareholders, branding is important, but I would say, it'll come.
Swamy, when it comes to cost, after Stellantis' earnings, there's a story that they're considering using Chinese EV technology. It's an industry that you know intimately well, obviously. Why is there still this grab, this movement towards China? How important is their EV market, despite the fact that there are international tariffs on that make it quite expensive for some car makers to try to incorporate technology from China?
Yeah, that's a great question. I think we have always focused on having modular systems, and having a footprint that can cater to the local needs. As an example, in China, we have over 35 divisions supplying to various OEMs there. We have about $5.5 billion in sales in China for producing for China. So we have a seat at the table. We understand what the requirements are for the OEMs there. When you start looking at homologation and the requirements in Europe and North America, obviously the system requirements are a bit different. We can leverage what we're learning from there and bring to different OEMs in Europe, in North America. So I think really it's about having the flexibility while you're designing the architecture. I don't think it's one solution fits all. In a headline perspective, they're talking about getting stuff, taking the synergies of developing a core, being able to address multiple platforms, staying disciplined in the market that you can address, which is like 80-20 rule, right? That's what is ultimately going to get you the economies of scale and hopefully leads to the affordability of the vehicles to the consumer at the end.
So I always think of Magna, Steyr, and Graz, and you're obviously in Michigan, but Magna International is a Canadian company, and the Canadian government has made very clear that it wants an auto parts supplier to do a JV with a Chinese company in Canada. And you're, one of the only Canadian companies with the know-how to build a complete car. Would you be interested in that? Because you also know China well. You have your own JVs in China. Would you do a JV with with a Chinese company in Canada?
Yeah, I think, Matt, it's the most important thing for us is that we are in the ecosystem in China supplying for Chinese OEMs and Western OEMs there, which means we know how they work, what's going on, how to work with them. We have typically not indexed, as you can imagine, with a particular OEM. We try to address the broader total addressable market as a system supplier and a solution provider. If there is an opportunity that gets us using our capacity and our capability to help the ecosystem there, absolutely yes. But the key is, as you can imagine, cannot be indexed to one OEM or one particular brand. But we have the breadth, we have the width, we have the portfolio, we have the footprint. So I think whatever happens there, it'll be a tailwind for Magna.
All right, Swamy, great to get some time with you. Hope we get to talk to you again soon. Maybe I can come to one of your plants. Magna International CEO Swamy Kotagiri, they are talking cars. Still ahead, we'll talk about the collector car market with Kenneth on. He's the president of Broad Arrow Auctions. Amelia Island is coming up, and they have 100 Ferraris up for sale. Although you're looking at a 918 Spider, now a 959. Some great cars. Just some great cars.
I am pleased looking at all of these cars, regardless of what they are. Let's get a quick check on the markets this morning. It's Nvidia that seems to be hurting us all. We're now down 1.8% for the NASDAQ. Nvidia now tumbling 5.1%, despite the fact it beat by 73%, a 73% revenue growth for the fourth quarter still down 5% this morning. Yields also lower by 3.5 basis points.
Buy the rumor, sell the news.
That's what I hear.
My old broker used to tell me. Let's get a look at some of the other single stock stories. Stellantis, as Dani mentioned, swung to a loss in the second half of last year after scaling back its EV push. They had a massive $21 billion write-down. But the CEO, Antonio Filosa, is bullish on North America.
Celsius sales energy drink more than doubled from a year earlier following its acquisition of Alani Nu. Shares are up almost 12%.
Hertz earnings missed, on earnings per share due to the government shutdown, but the company expects steady growth in the coming months.
And then finally, let's just take a look at crude. Those spiking, now up 0.5%, with the U.S.-Iran nuclear talks signaling little improvement.
Coming up, Mark Pinto of Moody's joins us to discuss the software concerns because of AI and the problems plaguing the private credit market. That's up next. This is Open Interest.
If you're a private equity manager, if you're a private credit manager, and you have less than 10% exposure, I think you're just a market and you're perfectly fine, and the market's doing quite well, the overall broader market. Okay. But if you have 23% exposure, which is actually the number for private credit exposure to software companies, you're having a lot of pain right now, and you're going to have to deal with a lot of fallout from this.
Marathon Chairman Bruce Richards there. Moody's has published new comments on the scrutiny surrounding liquidity risk in private credit funds with growing retail exposure. Joining us now is the man behind it, Mark Pinto, Global Head of Private Credit at Moody's. Mark, first it was the software concern. Now it's liquidity around these retail funds. Just how existential of a moment is this for private credit? Is there going to be some real pain and scarring coming from, again, all of these risks that we're now starting to flag?
Yeah, thank you very much for having me on. I think you have to realize that this market is in the early stages of maturity, and you're going to see a lot of bumps along the way. As you mentioned, there was a lot of scrutiny around software exposure. We have said that the question is not good or bad software exposure. It's what is it? How well is it embedded? What is the structure of the loan being provided to the software company? So there's a lot of issues around that. We've also seen a lot of issues of late around liquidity. Retail investors perhaps not understanding the features of the private credit market, and that's created some volatility.
Yeah, I wonder about the Boaz Weinstein said a couple days ago, one of the greatest accomplishments of private credit masters of the universe was convincing the market that this is the best thing since the internet, when it's really just lending money to small companies. What's the differentiation, though, that you actually see, Mark?
Yeah, private credit is offering something that the banks and the public markets have not offered to date. They're providing bespoke lending there to borrowers. They're providing certainty of execution, and they're providing speed. And to the investors, they're providing diversification, duration, and enhanced yield. And the alternative asset managers are managing that paradigm, and have seen a lot of growth as a result of doing that.
Mark, I was speaking to a lawyer that does a lot of private credit work last night, who basically said the Blue Owl stuff is a red herring. KKR, Ares share selling off, all of that is a distraction. The real issue is these more mid-sized, mid-market lenders that have, because of competition, had cov-lite deals or have just rushed and signed essentially really bad loans that they've done PIK, they've done it once, they've done it twice, and finally things are going home to roost, and they are saddled with these zombie companies. Are you seeing the same pressure in these, again, more mid-market type lenders, that there's some real issues among them?
I can tell you we haven't. This current episode is really all about liquidity. It's about providing liquidity to retail investors that are investing in long-dated assets. The assets themselves have performed quite well. And quite frankly, the recent sale of assets by Blue Owl at roughly par for a large portion of one of their funds shows that asset quality is actually pretty strong. This is really a liquidity story, not an asset quality story today.
Mark, do you think it was then, I know the market reaction to it was pretty bad, but do you think it actually makes sense then what Blue Owl did? Put the gates up for the redemptions, but instead return money on a more regular basis?
I mean, there is a soft promise that business development companies have, and that is around providing roughly 5% of their assets in towards redemptions every quarter. It needs to get approval by the board. Typically, we've seen them give that 5%. In periods of stress, we've seen them go over that 5%. So Blue Owl recently went over that 5%, but that's not new. We saw that during COVID, where a number of other business development companies provided redemptions up to 6, 7, and 8%. These elevated redemption periods typically last 1 to 2 quarters. We saw elevated redemptions in the fourth quarter of 2025. We expect to see elevated redemptions again in the first quarter of 2026. But what's important to note here is on a net flow basis, business development companies are still seeing positive inflows. The outflows is just one side of the story.
They are still trading at such an extreme discount to NAV, Mark. It's pretty remarkable. I mean, are any of the fears founded, do you think? We were just talking with the CEO of BXPE, that's Blackstone's private equity portfolio or product for wealthy, who was saying investor education is so important. Do you think that there is just an issue where maybe the Blue Owls of the world haven't, or other BDCs haven't fully educated their investors enough to say, hey, maybe you shouldn't expect as much liquidity from this? Like, where are the mistakes being made? Because clearly there is some fear out there.
Yeah, the market has definitely been spooked, and it's moved much farther beyond just the pure BDCs. And that has to do with the lack of transparency, the concerns around valuations, and the illiquidity of this market. But what I'd like to really emphasize is that illiquidity is a feature of this market. It's not a bug. There is a need for more investor education. That is for sure. Retail investors are used to liquidity. Institutional investors are not, and they're very careful and they're very thoughtful and typically buy and hold investors. Retail investors, again, are not that type of investor. So as the industry seeks to bring in retail money, they need to do it very carefully with education. And this is just highlighting the challenges that the private credit industry is having now and will have for some time as they bring in retail money and get retail investors up the learning curve.
Mark, I only got 30 seconds here, but just hearing from you, have they gone too far too fast then? Are they bringing in money faster than they are doing that work to educate?
That is a really good question. The market would tell you that maybe there's been investors who have rushed into this without full knowledge and full understanding of how this market works and the illiquidity that is present there. And so we'll have to see. But there may be a small pullback in the short term, but longer term, we think the trajectory of the private credit market will continue in the way we've seen it recently. Someone asked me the other day about, what inning are we in?
Yeah.
I would say the national anthem hasn't even been sung yet.
Wow.
There's a long way to go.
Hey, Mark, you'll have to come join us. This has been brilliant. Thank you so much. Come join us again. That is Mark Pinto of Moody's. Coming up, some more cars now.
Ferraris, Lamborghinis, Bugattis. They're driving a red-hot boom in collectible cars, but it's really the newer ones, not the older ones. It's the Radwood cars. We'll talk to Kenneth On of Aero Auctions about that next. This is Open Interest. The collector car market is booming, fueled in part by heightened interest in so-called modern classic supercars from brands like Lamborghini, Ferrari, and Porsche. Broad Arrow is among the auction houses capitalizing on that surge. The company delivered more than $624 million in total sales for its parent company, Hagerty, last year, and it's on track to bring in more than $100 million next week alone at Hagerty's Amelia Island. Joining us now is Kenneth On. He's the president of Broad Arrow Auctions. Kenneth, great to have you on the program. There's this whole Radwood era car craze that I think is so interesting. And Dani points out this is probably because millennials just now have money, right? Is that cohort of people rich enough to buy these cars?
Good morning. Thanks for having me. And you're absolutely right. I think we're seeing, much is talked about great wealth transfer from the baby boomers to the younger generation, in addition to a lot of the younger generation who are very successful in their careers. And we are seeing a real shift in interest levels and demographics with respect to cars. And that happens to be focused much more on modern supercars and hypercars today.
So, what are the hottest? I mean, I remember when people were saying, "Oh, the Ferrari FF is the cheap, growth car to buy," but now it's already gotten to 200 grand. And what are the cars you can pick up, Kenneth? You think for 80, 90, 100 that are going to be future classics?
Yeah, it's all across the board with respect to price points. But you're right, a lot of 80s and 90s cars that are also rare and desirable and hard to get. So, for example, I'll pick an example. Porsche Carrera GT, kind of considered the penultimate supercar of the analog generation from the mid-2000s. That market we're seeing exploding over the last several months. And we've got one coming up in an auction without reserve. So it'll be interesting to see where that market is. But also, the Fast and Furious movie era, the Japanese JDMs they're called, so Nissan Nismo to AMGs from the 90s. It's a very, very hot market. We're seeing almost a parabolic increase in price points for those cars over the last couple of years, and particularly in the last several months.
All right, so we're looking at some of these, and by the way, the Carrera GT, it's already $1 million car. The 918, I think one sold for over $6 million last month. The 288 GTO is already too old, right? People want the Enzo now. What about the Bugattis? Not the Chiron, but the ones that used to be multi-million-dollar cars. Are those losing value? The ones that Jay Leno prizes?
Yeah, it's a very good question. It's actually interesting. It's all relative. So truly unique, collectible pre-war cars or older cars are still doing very well. It's just that on a relative basis, the modern cars, the price appreciation has accelerated far faster. But if you have a beautiful pre-war Type 34 Bugatti, those will continue to do very well in this market because they are truly part of automotive history that are very rare and hard to get. I think what we're seeing now is the high quality cars with great provenance and history continue to do well, but the buyers are more selective as it relates to that genre of cars because you need specific knowledge, history files, and et cetera, whereas modern cars are a lot easier.
You need to know about it. All right, Kenneth, great to have you on the program, president of Broad Arrow Auctions. Hope we can get you back soon and get McKeel on as well. Listen to my podcast with Hannah Elliott. It's called Hot Pursuit. And if you care about cars, I feel like it's a must listen.
I don't feel like it. I know it's a must listen. A quick check on Nvidia as we head towards the break. Down nearly 5% this morning after a blockbuster earnings report.